Carley.
Hi.
So it's nice to have you back on the podcast. Let me do the bio introduction first, and then we can get to the questions. Okay.
Thank you.
So Carley Garner is an experienced commodity broker with decalitrading.com, a division of Zena in Las Vegas, Nevada. She's also the author of 4 books. The latest titles are Higher Probability Commodity Trading and A Trader's First Book on Commodities. She also writes a monthly column for Stocks and Commodities magazines. Garner specializes in various methods of commodity market analysis, but is best known for her technical analysis contributions to Jim Cramer's Mad Money. After graduating from UNLV as a Magna Cum Laude, is that how you say it? Carley jumped into the options and futures industry with the most recognized names in the business. She is
yeah, that's good enough.
She's a regular contributor to TheStreet.com and its Real Money Pro service, as well as multiple other media outlets, highlighting the commodity markets. Welcome, Carley. Like I said, it's nice to have you back on the podcast. So we're gonna start with you defining to us the difference between investing and trading when it comes to commodity trading, for those who can't tell the two apart.
Thank you. It's a pleasure to be. Okay, so I mean, you make a valid point. There's a huge difference between trading and investing, and unfortunately, most people don't really understand that. In my view, anytime you're participating in the commodity markets in any manner, whether it's trading futures, trading options, or even investing in ETFs, you're speculating. You're not investing. You are trading. And the reason I say that is commodities don't behave like stocks. And in stocks, there's a reasonable expectation that they're going to go up over time. I mean, obviously, there can be times where they go down, or there can be long stretches where they go sideways. But during that time, you're earning dividends or interest or some sort of cash payment, usually, not always, but even if you're not, stocks generally in the end will go higher. Commodities are absolutely not like that. For example, if you would have bought crude oil and several years ago around $150 a barrel, it's been as low as 27, 28, which obviously would be a massive, massive loss. And we've been as high as almost, roughly 70, but obviously that can't be categorized as investment, because you're talking about a market that trades sideways more than it necessarily goes higher over time. So it's just a different ballpark. So in my view, when you're talking about investing, you're talking about earning some sort of interest or dividends and a reasonable guarantee that you'll eventually make money if you stick to it in the long run. And that's just not how commodities are. It's pure speculation, which can be frustrating at times, but it can be great at times when you're on the right side.
Okay, so is it the same as when you're investing in commodities? Is it the same as buying a share price of, say, oil and waiting to earn dividends out of it? Is that the same kind of logic?
So, right. So, I mean, the thing to understand about commodities is, and again, whether you're trading ETFs, futures, or options, the only exception would be if you are trading individual stocks, like, for example, gold miner stocks, not the underlying commodity. But if you're trading the commodity itself, there are no cash flow. It's all price speculation. So for you to make money, the market has to go up. If you're on the long side, obviously, you can short it in the futures market relatively easily, but your price speculation has to be correct. There's no cash flow to cushion your blow. However, we can somewhat mimic an investment or some sort of cash flow with the use of options. We do that all the time. So if we go long gold or crude oil or whatever it is, we typically look to sell some sort of option against it. So we might go along the market and then sell a call against it, kind of like a covered call strategy in stocks, but we're usually using a strike price really close to the money or even at the money, because it brings in a lot of premium and gives us a downside risk buffer. And we found that that's one way that we can convert the futures markets, which are a price-only speculation, into a product that also offers some income. So if the market trades sideways or lower, we can still potentially make a little money. So in other words, we're kind of almost turning the futures markets into something similar to a stock that pays a dividend.
Okay, I understand that. So Carley, how have you managed to remain consistent and nurture your trading skill to date? and what are some of the things that you cannot compromise on every time that you decide to place a trade?
Okay. So the thing about trading commodities is I have yet been able to use the word consistent. We have commodity trading comes with good times and bad times, big runs and drawdowns. That's just, unfortunately, that's just how it is. So, and the market's always changing. So as a trader, we always have to kind of attempt to trade with it, and that's hard to do. As humans, we are creatures of habit, so we like the same thing over and over and over. But that's the exact wrong thing to do when you're trading commodities or probably anything else. You have to adapt with the market conditions and that sort of thing. And sometimes they can change really quickly. It's not like somebody sends out a memo and lets you know that the market conditions are changing. What we've learned just in recent months or years is that we generally like to have some sort of hedge in place, almost always have catastrophic insurance in place, just in case we are dead wrong. Every once in a while, the market moves so dramatically that if you're in the wrong place at the wrong time, you can erase years worth of hard work in a couple of days. And we saw exactly that earlier this year in the S&P. Anybody trading the S&P, if they were short in January, they probably took a massive hit to their trading account. But if they were long in February, the exact same thing happened. So the market just kind of wiped out a lot of the shorts and then came back and wiped out a lot of the longs, and it taught a lot of lessons. We no longer will have naked options. So going forward, the one thing we don't compromise on is making sure we have some sort of insurance in place just in case something really out of the ordinary happens. It doesn't happen very often, but it happens, you know, even if it happens once every 2 or 3 years, that's enough to really ruin a trading account. So we always put some insurance in place. It might be the type of insurance that only pays off in a massive catastrophic move, but that's okay. That's what we need it there for. We don't really need it for the normal ebbs and flows. And so we've been doing that sort of thing and just making sure we have some sort of loss limit in place. And we usually do that through the purchase of options, whether it's a call option or a put option. We'll have something out there to protect us against runaway losses.
All right. And then you personally prefer trading currency futures rather than trading Forex. Why is that the case, and what are some of the differences between the two, the currency futures and Forex?
The main difference between currency futures and trading currency in the Forex market is there are basically just two different marketplaces. In futures, you're trading on a centralized exchange. Most people that are trading currency futures are trading the Chicago Mercantile Exchange futures products, but there are others. In Forex, you're trading the spot market. And honestly, the Forex market, people like to try to make it seem like it's some sort of simple giant marketplace. In fact, you always hear these things about how it's the most liquid and the biggest marketplace in the world. But that's not necessarily true, because Forex is basically hundreds, maybe even thousands of little tiny markets that are put together. So for example, if you're trading Forex with one brokerage firm and you open an account with another brokerage firm, you're still trading Forex, but you're trading on two different marketplaces. That broker is establishing liquidity providers for you to trade against, and you're sometimes trading against the broker. In futures, in currency futures, it's not like that at all. All orders go to the same place. They're all going to a centralized place. Whether you're trading with whichever broker you're trading with, it doesn't matter. Your orders are all going to the centralized place, which is the CME Group's currency futures. So they're more transparent. There's more regulation. There are better money safety guards. For example, in futures, the way the rules are written now, I know in real life, it's kind of played out a little differently with some of the brokers that have gone out of business, such as PFG Best. But in theory, if you're trading with a futures broker, your money is held in an omnibus account. It's separate from the brokerage firm's funds. So what that means is if the brokerage firm goes out of business, if they go bankrupt, your funds are still sitting in a trading account. You're unaffected by that. Other than you have to get a new broker, but your money is safe. In Forex, that's not the case. In Forex, the brokerage is mingling your funds in your trading account with his funds. And so if he goes bankrupt, or that brokerage firm, no, I shouldn't say he, if the brokerage firm goes bankrupt, your money goes down the tube with it. And so those are the two primary differences between futures and Forex. So to summarize, better regulation, more transparency, and better money safeguards. That's why I prefer trading currency futures over Forex.
Okay, and you did mention something about liquidity. So when it comes to options, because you also do option trading, when it comes to options, which markets present the most liquidity for retail traders? And also tell us where your edge lies in option selling.
Okay, so in the world of commodities, there's probably about 40 to 50 commodity markets, but if you're trading options, you really want to stick with liquidity, and there's probably only about 10 to 15 markets that people have any business trading options in. And of those, there's probably only about 5 or so that really should be comfortably speculated in. So we try to stick to liquidity. We will venture out into other markets if we think that there's opportunities and it's worthwhile and it's worth the risk. Because you have to keep in mind when you're trading in an illiquid option market, the bid-ask spreads are going to be wide, so the transaction costs are a lot higher, because when you're getting in and getting out, you're basically getting, you're paying the VIG, or you're getting, I don't want to say taken advantage of, but in an illiquid market, it feels like you're being taken advantage of sometimes when you're getting in and out. So you leave a lot of money on the table just in the transaction of entering and exiting and trade in an illiquid market. So you want to trade that type of a market less than you would a market that it's easy to get in and out of. In addition, especially if you're doing some option selling, which we like to do option selling, you never want to be caught on the wrong side of a trade in an illiquid market, because you can generally find someone to take the other side of your trade if you want to exit, but the price might be outrageous. So it's really just not an experience you want to be a part of. So sticking to liquidity is important. The markets that we tend to focus on the most because of liquidity are the stock indices, so the E-mini S&P, mini NASDAQ, mini Russell. E-mini, out of those, the S&P is by far the most liquid. The other two are tradable. We also like crude oil, the grains, corn, wheat, soybeans. We do a lot in soy meal, even though it's a little less liquid. The margins are a lot lower and it doesn't move as quick, so soy meal is a good one to look at. We also look at markets like the euro, the yen are very liquid. The treasuries are extremely liquid. The 10-year note, 30-year bond are very liquid, and those are great option markets. We will venture into natural gas. The liquidity is pretty decent in natural gas. It's not great, but it's decent there for the options. And sparingly, we'll trade things like the softs, sugar. Pretty much just sugar. Every once in a while, cotton, very rarely. But and the meats, we will trade hogs, live cattle, those sorts of things. Again, the liquidity on those are getting a little bit skimpy, but if you see a good opportunity, it's worth it. But it's very, very important in general to try to stick to the most liquid markets. So if you're really wanting to, if you're a new trader, you're looking to get in, try to stick with treasuries, maybe a couple of the currencies like the euro that are highly liquid, and the grains, corn, wheat, soybean.
Okay, and because you use options as a tool for your hedging, yeah, for your risk management tools, can you take us through an instance where you've used a call and a put option, say when you're trading crude, because it's one of the most liquid things that you trade in?
So we do a lot of hedging with options, and the reason being, if you're going long or short a futures contract outright, you're immediately making or losing money, obviously, but you're exposed to extreme directional bias. So if you think the market's going up and you go long a futures contract and the market goes down, you're obviously losing money, but there's no buffer, and there's no way to manage that risk other than to place a stop loss order, and we know how that goes. Stop loss orders have a very high tendency to get elected, to get triggered right before the market goes in the intended direction. So they can, in my opinion, stop loss orders have the tendency to do more harm than good. And for that reason, we like to hedge our future speculations with options, and we do that through selling options against them and buying options against them, and maybe even both. So for instance, if we want to go long a market such as corn or soybean meal or something like that, if we do buy the futures, we first of all want to make sure that we have some sort of income hedge, so that, like as if we were trading stocks that have dividends, we have a risk buffer. Remember, commodities don't have a risk buffer built in, so we can create one by selling a call option against it. So if we go long corn and we sell a call option against it, we bring a premium in, and that premium cushions our downside. If corn goes down a little bit, the money that we're making on the option is offsetting our losses on the futures, and it all kind of equals out. If the market goes up, we're making money on the futures, we'll be losing money on the short call. However, we're still collecting time value erosion, because the option Options have two components of price. They have time value and intrinsic value. So at no matter what happens, even if the option's in the money at expiration, the extrinsic value has deteriorated. So for long a futures contract and short a call, even if the market's going up dramatically, we're still slowly gaining extrinsic value. So we can protect that by purchasing a put option below the market. So as you can see, we're selling a call option to bring in income, and we're buying a put option to make sure our risk is limited. And we can usually do that sort of thing with very low margin because the risk is low. And the idea is the market can go up, down, or sideways. The only way we lose money is if it goes down sharply. And if it does go down sharply, we have a risk buffer in place so that our losses are limited to some particular amount. Those losses might be limited to a rather substantial amount, but at least we know what the worst case scenario is at any given time. So that's the idea of hedging futures with options.
Okay, and speaking of biases, because you did mention directional bias, and traders, whether you're a beginning trader or well advanced in trading, there's some biases that we tend to have psychologically. So is directional bias in any way related to hindsight bias?
We almost always have a directional bias. So the idea is when we put a trade together, I mean, every situation is a little bit different, but we generally will try to put a trade together, if possible, that has two ways to make money. One way to make money, if the market trades sideways, we collect premium, options erode, we make money that way. But we almost always have a directional bias. And so the other way we can possibly make money is if we pick a direction and the market goes the way that we want it to go. In that situation, we might be making money on the futures contracts and losing money on the options, but that's okay. The difference is in the way that we structure trades. A lot of times we're doing these trades with 3 to 6 months expiration, so they have a lot of time on them. So if our directional bias isn't necessarily well timed or correct, hopefully we can make money on the premium erosion, but that takes a lot more time to occur than if our directional bias is correct. Sometimes we can take a profit in a trade that expires in 6 months, but we've only been in the trade 2-3 weeks. So sometimes we can take a quick profit if our directional bias is correct. Rarely will we do some sort of short option strangle or trade that has no directional bias. Most of the time we are trading against the trend. We're looking for markets that are overbought or oversold. Obviously that comes with some risk. Sometimes overbought markets can become even more overbought, and that's the risk, and that does happen occasionally, which is why we try to get that catastrophic insurance in place. But more often than not, you'll find that markets are like, they're on a pendulum. They swing one way and then they swing the other, and that's generally what you see in markets.
Okay, so because it seems like you're more of a swing trader when you're working with those timelines, and with technical analysis, because you basically trade the trend. Do you trade the primary trend and or the secondary trends? And if you do, how do you execute that in your trading?
Well, I tend to focus on technical analysis, but we do also focus on seasonal analysis, and we also look at the COT report, which is the Commitment of Traders report. It's issued by a government agency here in the US, the Commodity Futures Trading Commission, and that gives us an idea of where traders positioned. Are they long overall? Are they short overall? And to what magnitude? And we look for markets that are overheated. For example, if everybody is long, or I shouldn't say everybody, that's not the right word, but if the majority of speculators are long the market, we tend to look to the short side and so on and so forth. But you're right, technical analysis is geared towards the study of trends. I'd say the majority of people are comfortable trend trading. They want to confirm that the market's going up, and once they finally get that confirmation, then they jump in and hope that it continues higher. The problem with that is trend trading takes relatively deep pockets. The markets, as I mentioned before, they're pendulums, and they generally, even if a market is trending and it trends for a very, very long time, the market tends to get overheated and pull back and overheated and pull back. And unfortunately, the beginning traders have a bad tendency to buy the highs and sell the lows, because once the trend is established, they enter the trend, and it's usually when it's coming to an end. And so you have to be really careful about that. As I mentioned before, we're studying trends, but not necessarily looking for big, long-standing trends. We're looking for trends to end or at least pause. And the reason we like to do it that way is when a market's been trending for a long time and it's coming towards an area where it might be potentially ready to reverse, the options tend to get expensive. The price gets a little bit volatile. So with our strategy of selling options against the trend, more often than not, that's the better way to play it.
Okay, and following up on the technical analysis topic and discussion, because price usually remembers and it's reflected in the charts. When it comes to commodities, like you mentioned that you trade grains and wheat, does correlation play a factor when it comes to your entries and your exits? So, like for example, when you trade corn and when you trade wheat, do you make your judgments based on how they play around with each other?
Yeah, actually we do. So for example, generally the grains, you mentioned corn and wheat, they generally move in the same direction. Not always. Most people don't realize, but wheat is actually on the opposite harvest cycle here in the US. So when corn and soybeans are being planted, wheat's being harvested and vice versa. So in theory, wheat should travel on its own and should do its own thing, irrespective of corn and beans, but for whatever reason, they do tend to follow each other. And so we recognize that. So what we do is, for example, if we hypothetically place a position in corn, thinking that the market's bottoming out, and so we put a bullish position on in corn, but we're wrong or early, and the grain markets continue to slide lower, instead of adding to our corn position, we will add to our wheat position or maybe add to a soybean meal position or something in one of the related markets that trade the same. That way we're dollar cost averaging in a market that generally behaves in the same manner, but we're doing it in a different asset. And so we get a sense of diversification there, although they all tend to travel in the same direction overall. They don't always travel together, and sometimes just a little bit of diversification between being long corn, wheat, and soybean meal instead of 3 positions in corn can help a trader, and it just gives us a little more comfort in going forward. So yeah, we absolutely do recognize that most of the time certain markets are correlated, and we play them accordingly. So on the contrary, if we put positions in markets that we know are correlated, but it's not with the mindset of a dollar cost average, it's more of just, hey, I like the setup in gold, and I also like the setup in silver, so we want to play both. We'd be very mindful of that, and so we will keep those types of positions very low risk because we know they're going to move in the same direction. It's almost like doubling up your bet. So we definitely keep an eye on that sort of thing.
Okay, what would you say about the importance of placing higher probability trades and sticking to the same rules rather than trying out new strategies every time a trade doesn't go your way?
Trying new strategies is something you want to do in your paper trading account or do sparingly. It's not something you want to continually do. Now, earlier in the interview, I mentioned that trading is a game of being nimble, trading with, changing with the markets and adjusting, and that's absolutely true. But you also have to be careful when it comes to trying out new things because those kind of things can get very, very expensive. If lessons, the market can teach very expensive lessons, and you don't want to put yourself in that situation. It can be stressful. It can be taxing on your financial situation. It's just not a pleasant experience. The importance of waiting for higher probability trades is absolutely important. Unfortunately, most traders, they get trigger happy, they want to be in the markets, they get excited, and they think they need to have something on. But I always tell people it's better to be on the sidelines wishing you were in the market than in the market wishing you were on the sidelines. So missing a trade should not be something that stresses you out. If you miss a trade, it's no big deal. Something else will come along, and it'll probably come along a lot sooner than you think. So regardless of what your strategy is and what you're looking for for a particular setup, be patient, make sure that everything comes into line, don't jump the gun on it, because if you do, chances are you'll eventually be in the wrong place at the wrong time. And even if you don't, you might be at the wrong place at the wrong time occasionally anyway. So again, you don't want to put yourself in a situation where you're just experimenting and messing around and things get out of hand, and that happens a lot. For example, I know of some traders that were just testing platforms and learning about option selling, and they sold a couple of deep out of the money options in the grain market, thinking that it was a test. They wanted to see how the market worked, how the platform worked, that sort of thing. They should have done that in their paper trading account. Instead, they did it in a live account. So an option that they sold for $50 a couple of weeks ago is worth $2,000 today. So that test did not go as planned. So you want to be really, really careful about doing that sort of thing. This is real money. You work hard for your money. If you're going to put a trade on in your live account, make sure that you've done all your homework. It's not just an experiment.
Yeah, and I'm glad that you talked about patience, and that covers, the art of patience in trading, because sometimes not taking up a position is a trade by itself. I think so.
So I tend to be, I'm not a huge fan of trading off of price targets. I do believe you should have them. So when you enter a market, let's say that you're patient and everything comes to you and you get an opportunity to put on a bullish position in the 10-year note or whatever the asset might be. At that point, you're probably going to have some sort of price target. You're going to think, okay, I believe the market has support at XYZ, and I think it's going to XYZ. So that's great. But you want to be really careful about getting greedy once the market does get towards your price targets. A lot of people are so worried about getting out at exactly a certain price that they end up leaving money on the table. So for example, I've seen traders more often than I'd care to have seen place an order to sell a futures contract at a particular price. The market gets within a couple of ticks of their price. They never get filled because it never gets quite to their order, and then the market reverses and they turn a winner into a loser. So it's a lot more important to make sure you do not turn a winning trade into a losing trade than it is to squeeze out an extra tick or two in the market. So trading is not black and white. Don't treat it as if it is. It's not a black and white game. There's lots of gray areas. If the market gets to the vicinity of your price target, take your profit. You don't have to wait for the last couple of ticks. In fact, it might end up costing you a lot of money. Saving a couple ticks sometimes can cost you a lot of money. So be careful with that.
And talk to us about the new developments that you have, the trading app that you've got, and where people can go and find your work.
All right, so yeah, we have, since the last time we spoke, we did develop a mobile application. So anybody with a cell phone or tablet can download our mobile app. It's available on the Google Play Store or the Apple Store. It's a free app to use, but there is some content within the app that's restricted to clients, but people that are not clients can access all kinds of video news, written news, information on trading, educational material, that sort of thing. And on a trial basis, or if you're a client of ours, you would receive trading recommendations. So we actually have pop-up notifications via the app that give people ideas on how to trade certain markets, give them technical analysis, rundowns, that sort of thing. So it's an informational app, and we're really excited about it. The name of the app is DeCarley Trading. If you just search for it on any of your app stores, you'll find it. You can also go to our website, decarleytrading.com. We have plenty of educational videos and articles. It's all free information. We want to make sure that everybody's educated and aware of what they're getting into before they actually get into it. So we're big on education. We feel like commodity markets do pose a good amount of risk, regardless of how you're trading them. And so we want to make sure that everybody is aware of that and everyone knows what they're doing.
All right, thank you very much for coming onto the podcast. You've been very giving with your information, and for that I'm grateful. So have a good day. Bye.
Okay, thank you for having me.